Okay, now number 3, the carry trade. This is a good one. The higher interest rate currency will either appreciate or depreciate less than predicted by uncovered interest rate parity. That's what UCIRP stands for. So we expect the higher interest rate currency to appreciate or depreciate less than expected. And so what we can do here is we can have a trade that generates some alpha for us. We borrow in the lower interest rate currency, convert that to, and then invest in the higher interest rate currency. And so we would expect that those currencies should change in value to negate that difference in interest rates, but over a lot of short-run periods, that doesn't seem to be the case. Typically, this means we're going to borrow in the developed market because that's going to be the one that typically has the lower interest rate, and then we invest in an emerging market because that's going to be the one that typically has a higher interest rate because it's less developed. So how do we go about doing this? So what we're doing here is we're trying to trade in the forward rate bias. So the future price, F0, is not an or forward price, I should say, instead of futures in this case. It's not an unbiased prediction of the spot rate at time t. It's going to be a reflection of the interest rate differential. So here, if we look at this equation, if I look at the forward price, and P/B is pricing currency divided by base currency or over base currency. That's going to be equal to the spot price, price currency divided by base currency or over base currency, multiplied by 1 plus the interest rate in the priced currency divided by 1 plus the interest rate in the base currency, where IP and IB are both periodic interest rates, whatever period of time we're looking to enact this trade over. So while it's usually profitable, it has generated significant losses in periods of market crisis, right? This isn't obviously a gain in all periods of time. What are we doing? We tend to be borrowing in the developed market, converting that to an investment in an emerging market, okay? So there is going to be some risk there in the short run. As long as there isn't a catastrophic failure of that emerging market currency, well, we tend to be able to capture that interest rate difference. We don't see the change in currency values to negate that interest rate differential. However, sometimes we have crises, and those crises tend to hit emerging markets worse. And so a lot of times the term for this type of trade, as well as some other types of trades, is that they're referred to as picking up nickels in front of a steamroller, is that you can enact this trade time after time after time and capture that interest rate differential, but then there's an Asian currency crisis like there was in 1997, or some emerging market collapses and its currency collapses as a result. So you go from making these nice, comfortable, small gains to suddenly having a very big loss that wipes out several periods worth of gains. So that's where the risk is that you have a significant left tail risk where you may have a catastrophic loss. However, those are rare enough to keep people coming back to the carry trade. So because it generates significant losses in these periods of market crisis, well, what's happening in those situations that we're having a volatility spike? Okay, so how do we implement the carry trade? So what we're going to do is we're going to borrow in and sell the spot market of the lower interest rate currency. Okay, so let's say that typically is going to be the developed market currency. Developed markets tend to have lower interest rates than developing or emerging markets. All right, so if it is the lower interest rate currency of the two, well, then what that means is that it's going to be selling at a forward premium. So we're selling the spot at a forward premium. All right, then we want to turn around and buy and invest in the higher interest rate currency. Okay, so because it is the higher interest rate currency of the two, that means we're going to be buying the spot and trading at a forward discount. Okay, so because it's a forward premium, we can say, yeah, that one, relatively speaking, is going to be overpriced. The one trading at a forward discount, relatively speaking, is going to be the one that's underpriced. So as long as those two terms hold over our time period, then we should be able to capture that difference and capture, hopefully, what we will view as alpha to us. Now, the number 4 here is we're going to look at volatility trading. Vol trading is designed to profit from changes in volatility. Okay, so what we can do here, so if you think back to derivatives, when we talked about hedging the delta, basically changes in the price of the underlying. So if we take a delta neutral position, that means the value of that position should be unaffected by changes in the value of the currency, what proxies as the underlying asset here in this case. So delta measures the change in value for an option for a change in the value of the underlying, the currency in this case. So if I want to go long call or short put positions, those are going to have a positive delta. Short call and long put positions are going to have a negative delta. Okay, so if it's been a while since you've thought about the payoff graphs of these different call and put trading positions, well, let's have a look at them here. Okay, so remember, if you go long a call option, that means you get no payoff until it breaches that exercise price, and then that's where you get your gain. Okay. On the other hand, if you were short that call, your payoff is just the opposite. You have no payoff, but then money's coming out of your pocket once you move past that exercise price. If we're talking about going long a put option, as that price declines, you get no payoff until it breaches that strike price, and then that's where you get your value as it goes below that strike price. Being short a put option, again, just the opposite, right? So as it breaches that exercise price, now that's money coming out of your pocket because you shorted or sold or wrote that put option. So we're going to go back to volatility trading here with the deltas. We talked about being delta hedged. Now let's talk about Vega. So Vega measures the change in the value of the option for a change in volatility, okay? So if we think about volatility for both calls and put options, it's increasing for both. Why do we buy options, right? We buy them because we're placing bets on volatility, right? Options only have a short lifespan, right? They have an expiration date. So that price of the underlying needs to make a big move in a relatively short amount of time for this to be a profitable trading strategy for us. So what are we looking for? We're looking for increases in volatility because that means prices are oscillating more wildly, greater chance of our underlying, our option becoming in the money as a result of the change in the underlying asset value, and so that's why we buy those calls and puts. So both call and put option values change directly with volatility. They're both increasing in volatility. If volatility goes down, that's bad news for calls and puts. So if volatility is expected to increase, we want to do a long straddle. Okay, remember what a straddle is. You're buying a call option and you're buying a put option. So I'm going to wave my hands a lot here, but what does that mean? Is that you've got the payoff of a put option and you've got the payoff of a call option together. If you have the straddle where both the call and the put have the same exercise price, that means your payoff has a V shape like this. You're going to make money on the call option if it goes up. You're going to make money on the put option if it goes down. So when you go long a straddle, what are you doing? You're placing a bet on volatility. You think the underlying is going to make a big move in one direction or the other. If you're long the straddle, you don't care which direction it moves. As long as it makes a big move up or big move down, well, then you're going to benefit as a result of you owning both the call and the put. That's what the straddle is. Now, a subtle change on that is something called a strangle, which is where we are buying calls and puts, but now instead of both of them being at the money, in other words, they meet at the vertex here of having the same exercise price, well, now they're out of the money. So it's going to be sort of a spread out V shape like this, okay? And so what that means is that it's going to be cheaper, first of all, to enact a strategy because you're buying options that are out of the money versus at the money. But then it also means that you're going to have this range in between those two stock prices where you have a zero payoff. The big picture, however, it's still a bet on volatility. If that currency makes a big move up or a big move down, hopefully it's big enough to where you get a payoff either on your call option on this end or your put option on this end. So that's what we call a strangle. Now, if volatility is expected to decrease, do just the opposite, right? Do a short straddle, do a short strangle. In other words, now we're the ones selling the option. What are we looking for in this case? We're looking for a zero payoff. Because if there's a zero payoff, well then that means we get to pocket the premium, okay? So if I were to draw this graph here, right? If I'm long the straddle, this is my payoff because I own the put option, I get the payoff of the put option, I own the call option, I get the payoff of the call option. So that's that V-shaped payoff that we were talking about. Now, the person that sells the straddle has exactly the opposite payoff, right? So I'm going to try and draw this with little dash lines here. So if I think volatility is going to increase, I want to be here. I want to be here right in this range here, right? This is where I expect volatility to be increasing, and so I want to get the benefit of it either from this put option here or this call option here. If I think volatility is expected to decrease, well then I want to sell the straddle. I want to be short it because in that case, if I think prices are not going to move at all or currency values are not going to move at all, well then my payoff is going to be zero, okay? Now, how does that make me money if I have a payoff of zero? Remember, there's a difference between payoffs versus profits. So now I'm just going to draw a graph of the short straddle here. This is my payoff, right? If I'm the seller of options, the best I can do is to have a payoff of 0, but because I'm the seller, I received the premium for those options. So here's my profit line here. If I sell both that put and that call, and that currency makes no movement at all, then what am I going to do? I'm going to capture this profit here because I sold these options for this premium and I had a payoff of 0. So I got the premium for both the put and the call. I get P plus C, whatever that sums up to. My payoff was 0, so that means none of that money came back out of my pocket, and so I pocketed that profit. So if I think volatility is going down, I want to be short the straddle. I can also be short the strangle. The strangle is going to look like this if I'm long a strangle. Now we're talking about out of the money calls and puts, so it's a little bit more spread out. If I'm going to be short the strangle, well then my payoff's going to look like this or look like this. If I think volatility is going to be low, yeah, I want to be short the strangle because, again, what's going to be happening here? Yeah, my payoff can only be 0 or negative. However, if the currency stays within this range, my payoff's going to be 0. And again, I'm going to have a profit because I sold these options for whatever their premiums were for the call and the put. And so that profit is going to be some positive number.